All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our weekly options recap. I wanted to jump on here today while the markets are still open, take a look at where we're at going into next week. Next week is a huge week for a variety of reasons, which I'll talk about in just a moment. Also want to talk you through some trades that we took here this week, as well as some trades that are setting up for next week as well. So with that, let's go ahead and dive in. Why is next week so important? Well, first of all, we continue to have the whole stimulus situation lingering out there, right? Is there going to be another stimulus deal, right? If so, when is it going to happen, right? I mean, we've had rumors in both directions now. I mean, they're doing everything they can to prevent any type of selling in this market, right? I mean, anytime the market starts to sell off, magically, we get a tweet or we get a headline that hits that says, oh, we've got some encouraging news. We're making progress on the stimulus. But we have yet to see anything. I think at some point, traders are going to start to shift from trading off of hope of more stimulus to show me something, show me a deal, right? And I think we're getting to that point here towards the end of this week. Next week is also crucial because we have a tremendous number of earnings releases upcoming in the tech sector specifically. If we go take a look at my watch list on the left-hand side, if we click on the red and blue icons next to those symbols, you will see that Apple has earnings out on the 29th. Amazon has earnings out on the 29th. Google has earnings out on the 29th. Facebook has earnings out on the 29th. And those are just to highlight a few. These are big, heavy hitters in the tech sector, all releasing their earnings on the same day. The NASDAQ is going to have a very busy stretch next week, solely based off of those earnings alone. I mean, if you start to see a 10% move overnight on Apple or Amazon, sure, we're going to see the NASDAQ and specifically other areas of the market react accordingly. So next week is going to be huge as far as news go. We are also creeping closer to the elections, right? A lot of uncertainty out there with, which way we're going to go here. How are the markets going to react to whether Trump or Biden wins? We'll have to wait and see how that plays out over the next few weeks. All that to say, what we've been talking about in these sessions here the last few weeks, being more conservative. I'm going to continue to take that approach right now. Smaller position sizes, more vertical spreads, specifically more credit spreads. That's the approach that I am taking personally. I've had some feedback on that from people saying, hey, Mike, I don't mind taking more risk right now, taking advantage of the news, taking advantage of the volatility that we have in the market. And that's fine. I don't have a problem with that as long as your level of aggressiveness is not to the point where the outcome of one trade or the outcome of one series of trades is going to prevent you from taking the next series of trades. If that's the case, it's never going to work long term. Because if you ramp up that risk and get to the point where your dependency is focused on, the outcome of one series of trades, it's not going to work out, because at some point you're going to blow out an account. We don't want to see that happen. I don't have a problem getting more aggressive if that's what you feel comfortable with, but within reason. And when I say within reason, I typically don't like to have more than 3 to 5% of my account at risk at any one time in any specific trade. Right? That's the typical risk that I'm looking for on the individual trades that I take. So I'm going to continue to be more conservative until we get through next week. Once we get past some of those tech earnings, once hopefully we get some more clarity on the stimulus plan. And ultimately, we have the election out there as well. But next week is going to be crucial. Once we get past next week, I don't have a problem ramping things back up and getting back to more of a normal position size approach in my own trading. From a technical perspective here, we've been talking about how it's really difficult to have any other outlook than a cautiously bullish outlook, because every dip has been bought, and every time we get any weakness in this market, it lasts for a couple hours, maybe a couple days at a time, and then we're just right back into a rocket ship to the upside. We're at some very key support levels here on a couple of different time frames, which I want to show you here now. This is the daily chart of SPY. We've been talking about how we've got all of these moving averages sitting right here below us as support. If I zoom in here, you will see the pink line is the 8-period exponential moving average. We've got the green lines down below. Those are the 20-period simple and exponential moving averages. And then we've got the yellow lines. Those are the 50-period simple and exponential moving averages. All of those just below us. So we've got this support zone from around 344 down to around 338-ish. We've got a block there that if we're going to get anything going to the downside, we need to break through those moving averages. It's going to be difficult to get that to happen. If these levels hold, let's say we get a stimulus headline to hit this afternoon or over the weekend, and we rally back to the upside, there's a couple key areas that I want to watch on the upside. First of all, we've got the swing high from a couple weeks ago, right up around 354. And then we've got the all-time high at 358.75. Those are areas on the upside. Should we get another round of buying here, those are going to be levels that we're going to want to watch as resistance. If we're going to break, right, we've been talking about the coiled spring pattern the last few sessions, right? And what we're talking about here is a market that it's been chopping sideways. We've had some decent range, but we're not really getting any follow through in either direction. At some point, that spring is going to continue to get tight and it's going to pop. We don't know when that's going to happen, nor do we know in which direction it's going to happen in. But when it does pop, I think we're going to get a really nice tradable move. So those support and resistance levels that we just talked about, those are going to be levels that we're going to want to watch closely next week to see if we do get a break. The catalysts are there. The news events are there next week to give us that breakout. So very, very excited to get into next week for sure. The volume. 22 million shares have traded so far today with 3 hours to go in the session. The volume continues to be lackluster. A lot of wait and see going on from traders. I want to see 100 million shares reached. If we get a market break here, I want to see the volume spike. We don't have that right now. If we continue to remain in this 50 to 70 million share range on SPY on a daily basis, it's in all likelihood going to lead to more chop and more indecisive price action. I want to see volume confirm the move here if we do get a break over the next week or two. We talk about the ATR, the average true range down at the bottom. It continues to contract. It's still a good number historically. The ATR on the daily chart is currently sitting at right around 5.4, just below actually. It's a decent number historically, but it's also been trending down here throughout the month of October. Want to see that pick back up. I want to see the range remain active. I do not want to get into that dull market where you don't have much to work with. The catalysts are there here over the next few weeks for that range number to pick up, and I want to see that start to stabilize and reverse back higher. Ideally, I'd love to get back up towards 6, that 6-ish range. So that's something we'll want to watch going into next week as well. The volatility, the VIX is still elevated. This has been one of the longest stretches that we have had in history, in the history of the VIX. Longest stretches of the VIX above 20. You don't typically see months in a row where the VIX is elevated above 20. You'll typically see it for a couple days, maybe a couple weeks at a time. Well, if you go back towards March, I mean, we've been in a volatile environment where the VIX has been elevated ever since. I would love to see it continue to stay elevated, but I'd be very surprised if you get past the election. I'd be very surprised if that volatility stays elevated at that point. Once we start to get past some of that uncertainty, I would expect the volatility to contract. Now, how does that impact what we do in the near term? I don't have a problem buying options right now. You just have to know that if you're going to buy an option, in all likelihood, you're going to pay up. Options are expensive. The volatility is still elevated. We still have uncertainty out there, especially in the tech sector with all of the earnings numbers out over the next week or two. The options are going to be on the pricey side. Not opposed to buying options. You just have to bank on that move happening quick enough and being a big enough sized move to make money. When volatility gets elevated, when the VIX gets above 20, that's typically when I am more interested in trading more credit spreads. If you're going to sell a credit spread to open up a position, you want to collect as much as you can up front. You want to sell high, right? And in this environment and volatility elevated and options are more expensive, you can actually get some pretty decent pricing on the credit spread. So we'll talk about that more in just a moment. The internals today, even though we do have the overall market lower, you can see some red here on the index products. When you start to take a look under the hood a little bit more, it's actually not as bad as you would think. That's why it's so dangerous just to come in and strictly look at the index numbers. Yeah, if you have the Dow down 150, the NASDAQ down 20, the S&P down a couple of points, normally at initial glance, you're saying, oh man, the market's getting hit a little bit today. But when you take a look, the volume ratios, minus 1.22 to 1 on the NYSE and minus 1.07 on the NASDAQ. Those are not numbers that indicate any type of panic selling. What I want to see on a trending day to the downside, I would like to see the volume ratio at a minimum -2 to 1. We don't have that so far today. It's more of a mixed bag here so far. The advanced decline line on the NASDAQ, only at -40. This is not across the board selling at all. If it was across the board selling, you would see -1,000 here on the advanced decline. We don't have that. It's just we have a few key areas, some of these tech names that are lower, and that's what's causing the weakness so far. On the NYSE, when I say NYSE, guys, I'm talking about the New York Stock Exchange, for those of you that aren't familiar with that, with that terminology. We're at +149. We actually have more names moving to the upside than the downside on the NYSE. So you can see, I mean, these internals are painting a very different picture than what the overall index products are telling us. Yes, price action is king, but when you start to take a look at these internals that are not all that bad, this is typically the market that you see bounce going into the afternoon. We'll see if that happens or not. I mean, time will tell, but I'm just not seeing any type of selling that leads me to believe it's get me out at any price. I mean, this is definitely more tame selling at this point. We did get one sell program that just kicked in. We did get a -1,000 tick reading here about an hour ago. So that's the only sell program that we've had so far today. And you can see it's been pretty muted selling. I mean, yes, we've been moving to the downside all session, but it hasn't been anything significant as of yet. All right, now let's take a look. Let me walk you through one of our overnight pop trades that we put on yesterday afternoon. This is one of those trades that we like to put on going into expiration. We open these trades up the afternoon before expiration, and then we look to close them out first half of the day of expiration day. We know that a lot of products have weekly options. Okay, so you can do this type of a setup every Thursday into Friday. And then you can also place these trades every Monday, Wednesday, and Friday because we have those Monday, Wednesday, Friday expirations on SPY, on the S&P 500 ETF. Well, yesterday we knew we had Friday expiration here. So on QQQ, we looked to sell a put spread, which is a neutral to bullish position. And what we did is we sold the 282.5, 280 put spread. And what that means is I'm selling the 282.5 put and then buying the 280 put at the same time. And the goal of this trade, we want to sell high and buy low. I wanted to sell high yesterday and I wanted to buy back cheaper today and pocket the difference. These options get cheaper if QQQ moves higher. The time decay will add up in our favor, and if volatility decreases. Any type of price movement above 282.5 and we're okay. The only move that hurts us is a directional move below 282.5. Well, have we had a big move higher here today? We haven't. In fact, we've had a move to the downside, right? The NASDAQ is actually down. You have the cash index down 20 and the futures are down 28. We've been dead wrong on this trade since we put it on yesterday afternoon. We sold this spread for 66 cents. We collected $66 per spread yesterday, and we were tying up just under $140 of capital per spread to put the trade on. We've been dead wrong directionally, and we just closed out of the trade for 35 cents. Okay, it gave us right around $30 of profit potential, which doesn't seem like a huge profit, right? But keep in mind, we tied up less than $140 of capital per spread to put the trade on. So you can put this trade on 10 times and still have less than $1,400 of risk. You put it on 10 times and all of a sudden you've got a $300 profit overnight, and we were dead wrong. That's why I love to use the credit spreads. I get questions on this all the time. Mike, why do you trade so many credit spreads? This is why. They are very forgiving. You don't have to be perfectly right. You don't need to get that big directional move in your favor. You can still make money on a move against you. How did we make money on this? Because prices stayed above 282.5. The time decay has added up. The time decay is falling off a cliff here because these options expire at the end of the day. Could we hold into expiration as long as price action stayed above 282.5? Can we just hold and book the additional $30 of profit? You could. My concern here is all it takes is one headline to hit or one tweet to come out this afternoon. The market reverses and all of a sudden we go from a really nice profit to a loss immediately. These are not trades that I like to hold to expiration. These are trades that I like to close out, take the partial profit. All right. So we were just able to close it out, and it took some time. I mean, it was a touch and go here this morning because the market was lower here earlier in the session. We were actually underwater first thing this morning on this trade, but we were able to close it out, take the profit, and we'll move on. Okay. And fortunately, we were able to book a profit, and hopefully going forward, if we look at some of these trades next week, which we will, if we can get some of those directional moves in our favor, those are the ones that are in and out immediately. We opened them up Thursday afternoon, and we were able to close them out first thing Friday morning. This one here today, we had to hold a few hours. So all in all, we're still in and out in less than 24 hours. That's why we continue to love what we're seeing with the overnight pop trades. Let's take a look at some of our key markets going into next week. Where are we heading? Let's take a look at SPY again, but now let's take a look at the 195-minute chart. This chart's going to give you 2 candles a day instead of getting only 1 candle a day on the daily chart. I've had some questions from people asking, why do I like looking at the 195-minute? It just seems like it's slow to react. Well, I love it because it's a really good balance. The daily chart for me is just too slow. The 195-minute, it definitely speeds it up, but it also does a good job of filtering out some of the noise. If you lower it all the way down to an hourly chart or a 30-minute, 15-minute chart, you're very much exposed to the movement intraday, and it's easy to get whipped around on some of those false breakouts. The 195-minute does a good job of filtering some of that out. What is our typical holding time on this chart? Anywhere from 3 to 30 days would be a typical holding time, just depending on market conditions. Well, we talked earlier in the week, for those of you that watched the midweek update, we talked on Wednesday about how we are interested potentially in a move to the downside on SPY, but we needed a few things to happen. Number one, I needed our trend strength histogram down at the bottom to go from blue to red. It did, indicating that bearish sentiment is starting to take over. But I also wanted to see price action break the 50-period exponential moving average. That is that white and yellow line here. Notice how price action came down. Touched it initially back on the 19th. We touched it and bounced right off of it. Notice here yesterday, we also came down, touched it, and bounced off of it. That's why if we're going to get short here, and when I say getting short, I'm talking about buying put options, I want to make sure that we break the 50 EMA. Until that level breaks, I'm not interested in putting on any type of a long put here. So still on the table, if we get this thing to roll back over here this afternoon or early next week, definitely interested on the downside, but I need to break the 50 EMA first. All right, so still leaning cautiously bullish here, just based on what we're seeing with price. We aren't able to see any of these big support levels break as of yet. They continue to hold every time we test them. QQQ, this is the NASDAQ ETF. Go ahead and load this chart up here as well. Very similar story. The trend strength indicator has flipped bearish. We do have a red trend strength histogram, but price action, you can see the last couple of days, we've just been straddling that 50 EMA. If that level breaks, I would certainly be interested in playing the downside. Now, let's take this a step further. We talked about the earnings that are out next week on all of the big tech names, Apple, Amazon, Facebook, Google. They all release earnings next week. The NASDAQ ETF, QQQ, even though it's an ETF, even though it's a basket of stocks, it's going to be heavily influenced by what those tech names do. Going into next week, there is, in all likelihood, going to be a pretty decent sized move on the NASDAQ. Not opposed to taking trades. I will trade QQQ right through earnings, but I'm going to do so with a more conservative approach. I'm going to do so with 50% of my normal position size, and I wouldn't definitely be more interested in selling a call spread here. I'm not actually interested in buying long puts because I just don't want to be that aggressive going into next week. So first things first, I want to see the 50 EMA broken on the downside. And if that does happen, I would take a look at coming in and selling an out of the money call spread. What does that look like? If I go over to the trade page, I talked on Wednesday about looking at a lot of monthly options out in November. And the reason I'm out in November for a couple of reasons, actually. They have better liquidity in most cases compared to the weekly options. And going out 28 days gives me a little bit of a cushion. It gives me the ability to hold the trade longer just in case we don't get the directional move to the downside right away. Maybe it takes a little bit more time. Going out 28 days gives me a little bit more of a time cushion there. So if we open up the November options, I'm going to go out to the 292 call. It's about $9 out of the money right now. Why did I go to the 292 call? It has roughly a 65% chance of closing out of the money. Or for those of you that like to use delta, it's got a delta right around 0.35. The reason I like to go to that option that has around a 65% chance of closing out of the money is that will give me a position in all likelihood. In many cases, it's going to allow me to risk between 2 and 3 to make 1. It's going to give me a decent risk to reward ratio. You're always going to be risking more to make less with a credit spread. And we're okay with that because we have multiple ways of making money. They're going to have a much higher winning percentage when compared to just buying an outright call or put. I'm going to right click on the 292 call, go to sell and go to vertical. That's going to pop up an order down at the bottom where I am indeed selling the 292 call. But instead of buying the 292.5 call like the system set me up initially with, I'm going to go with the 294 call. I want to stretch those strikes out a little bit because I want to make sure I can collect enough premium to make the trade worth my while. By trading a $2 call spread here, it's currently trading for around 80 cents. We'll just lock that price in at 80 cents. Click on confirm and send. I would be in a situation here now where I'm risking 120 to make 80. Pretty decent risk to reward ratio. I have 5 ways of making money on the position. I make money if QQQ moves up, down, or sideways. As long as price stays below 292.80, I get to make money. I also make money from volatility decreasing. We already talked about earlier, volatility is elevated. If it decreases, that helps me. I make money if time decay adds up. So now I've got 5 ways of making money on the trade. It's a very forgiving type bearish position. Now, would I place this trade now? No, this is a trade that's on my radar for next week, but I first need to see the 50 EMA broken. I need to see that yellow line broken. Right now, it's currently sitting at 282.68. I want to see that level broken before I go ahead and initiate that type of a short call spread. But it is on my radar next week, so we'll see what happens. IWM, this is the Russell 2000 ETF. We've just been stuck in the sideways pattern after getting this leg to the upside. The Russell, the IWM chart here has been super strong. We have not seen any type of significant selling, but we have been consolidating in here, just kind of resting, potentially looking for another wave to the upside out of this pattern. If we break the red and blue line here, that's the 8-period exponential moving average. That would have me looking for further movement to the downside. So we'll just want to wait and see what happens there next week. Nothing to do here as far as new trades on IWM. Out of the index products, SPY and QQQ, the S&P 500 ETF and the NASDAQ ETF, those are definitely of more interest to me than the Russell. Nitu. So yeah, some of this might be new to you. Some of the terminology might be new. Feel free to ask questions. More than willing to help out. We're in here every Wednesday and Friday. So feel free to log on, ask questions, more than willing to help out with some of the terminology that we're using here. All right, let's go ahead and take a look at some of the names on my radar for next week. Let's take a look at Snap, symbol SNAP. This is Snapchat. Snapchat had earnings out this week. The market loved the earnings. The stock is actually up almost 50% this week alone. It's been a phenomenal move. You can see it here. I mean, it's just, this is a runaway train here to the upside. Price action down here on our pulse indicator. It's now plotting green and blue. What that's indicating here, when it starts to plot blue like that, it indicates that price is at a 4 standard deviation move on the upside. In other words, we are massively overbought. Okay, 0.1% of all occurrences will fall outside of this range on the upside. Chances are going into the next week or two, we're going to see either a pause or a reversal to the downside. That's how I would be playing it. All right, now we actually, going into earnings, we actually sold an iron condor on this one earlier in the week. We actually took a loss on the trade. It did not work. We weren't expecting a 50% move in a week, but obviously that's what we've seen. So now I'm looking for a new trade going into next week. Let's go back over to the trade page, and I'm going to change the symbol to Snap. We're going to go out to the November options, just like we did over on QQQ. We're going to take a look at selling an out of the money call spread. I'm going to go to the 44.5 call. Again, it has a 65% chance of closing out of the money. I'm going to right click on that option, go to sell, and go to vertical. It's going to pop up an order down at the bottom where I am selling the 44.5 call. And I'm going to take a look. Let's take a look at buying the 47 call at the same time. If we take a look at this trade, right now it's trading for 68 cents. That way we could collect $68 per spread to put the position on. I would be risking $182. That's the max loss on the position, the most I can lose. Now, why would I be risking 3 to make 1? Because we, again, would have 5 ways of making money on the position. We make money if the stock moves up, down, or sideways. As long as it stays below 45.18, we make money. We make money if volatility decreases, and we make money if time decay adds up. We just took a look at the chart. We're massively overbought. It doesn't mean the stock has to completely collapse, but with a short call spread like this, we don't need it to. We just need the stock to stay below 45.18. If it does, we make money. It's a very forgiving trade. The most we make is $68. The most we could lose is $182. It's not tying up a ton of capital. If you've got a bigger account size, sure, you can put this thing on with as many contracts as you want. You put it on 10 times, you've got $1,800 of risk, and now you've got $680 of profit potential. So this is definitely a trade. I've already put this trade on a couple times today. I'm legging into my position, meaning I'm just starting small, putting on a few spreads here and there, but I am looking to add this afternoon and potentially next week if we do get further buying going into next week. So that is Snapchat. Stitch Fix, SFIX. If we take a look at Stitch Fix, very similar chart pattern in that we've had a pretty impressive run higher. We do have yellow bars plotting on the pulse indicator, indicating an overbought condition. Notice what's happened since those yellow bars started plotting on the pulse. See how price action has started to chop up in here? Very typical. When you start to see yellow pulse bars like this, it's very typical to get either a sideways move or a reversal in the other direction, in this case to the downside. This is another potential short call spread opportunity. DraftKings, DKNG. Very similar idea here in that we have yellow pulse bars down here at the bottom, but now they're on the downside. DraftKings is actually oversold in the near term. So we would potentially be looking for a bounce to the upside here. This is potentially a short put spread opportunity. I don't care if the market moves up or down. It does not matter to me. I do want to have a mix of bullish and bearish positions on. We've talked about a couple of bearish positions. Now here's a bullish opportunity. We want to mix up those trades. So DraftKings definitely on the radar for next week for selling a put spread. That would be a neutral to bullish position going into next week. XLF. This is the financial ETF. The financials have come to life a little bit here over the last 2 days. XLF did actually give us a bullish reading here. We did get our trend strength indicator to go from red to blue. We did get a long setup that did trigger in yesterday. The entry point was at 25.10. That's that blue plus sign right there. We did put on a long call position yesterday. Our stop is down at these pink dots. Our stop is down at 24.56. So we definitely are looking for the financials to come to life. We talked about this originally on Wednesday. I mentioned how the financials have lagged behind, and I could certainly see a scenario where the financials take the baton from the tech sector. We start to see some rotation out of tech into financials, and we've certainly seen that the last couple of days. So whether we have some staying power or not, we'll have to wait and see. But so far, we're looking for a continuation to the upside in the financials next week. The financials have all had their quarterly earnings, so we don't have to worry about any earnings like we do on tech, some of the tech stocks for next week. So definitely looking for another wave higher on the financial names. XLE, this is the energy ETF. Same situation here. Energy has been lagging behind, but we have seen the energy names come to life a little bit, specifically yesterday. We haven't had the follow through higher yet, but we do have the trend strength indicator that briefly went blue yesterday. We saw bullish sentiment starting to take over. But remember that white and yellow line here, that's the 50 EMA. When I get an entry point that close to the 50 EMA, I'm going to ask for that level to be broken on the upside first. So I'm interested on the long side on XLE, but I do want to see another wave higher. I want to see price action break above the 50 EMA next week. So that's another one that's on my radar. We just haven't had confirmation yet. Some of the tech stocks, again, Apple, I'm not going to initiate new trades here on Apple, Facebook, Amazon, Google. I'm not going to do so personally until we get past the earnings next week. A lot of times when you get this close to earnings, you'll get chopped to kick in. You'll get some indecisive wait and see price action. Not saying that's guaranteed to happen here, but I want to be cautious. I don't want to jump into a trade and then just get blindsided by a huge move overnight with earnings out next week. So Facebook, it's definitely leaning bearish. It's definitely been weak the last week or so, but I'm not in a position here. I'm waiting for earnings to come out. Same goes for Amazon and Facebook. I mean, you can see here on these charts, the system's giving us setups here. I'm going to play it cautious, just waiting for earnings to come out. Amazon also in a bearish pattern here with the trend strength indicator firmly red. So we'll wait and see. We'll talk about this next week. It'll be very interesting to see. Once we connect next week on Wednesday and Friday, we'll certainly have more insight into how these earnings impact trading next week. All right. So if you have any questions on any of the markets that we talked about today, if you would like me to take a look at any other markets, feel free to type in those symbols. Otherwise, I will be back on Wednesday next week for our next midweek update. And feel free, guys, to join these sessions and type in symbols. I'm more than willing to take a look at markets that you're interested in, walk you through some trades that I would be curious curious in taking potentially. So feel free to bring any questions to these sessions here going forward. So I am going to start wrapping it up for the week. Enjoy your weekend, everybody. And next week is going to be a very busy week with all of the earnings and stimulus news and elections upcoming. Lot to look forward to next week. So looking forward to it. So enjoy your weekend, everybody. Thanks for taking time to join us here today. Robert, Intel, yes, INTC. So Intel did have earnings that were out. So let me load up the chart here. So Intel definitely had earnings out overnight. Intel, it was really showing a nice bullish pattern going into earnings. We had a nice bounce off of the lows going back into September. It gave it all back and then some. Here's how Intel is down 10 or 11%. So here's how I would handle it. The day of earnings, or in this case, the day after earnings, I don't initiate any new trades. When you start to see a 10 or 11% move on Intel, Robert, if you look at Intel for any length of time, I think you would agree. Intel, a 10 or 11% move intraday, not normal. That's certainly an outlier move. I don't want to base my trading decisions today off an outlier move where the range is extreme, the volume is extreme. I would rather give it a couple of days, let price action settle back into normal, and then reevaluate. All right. So if you are in a position on Intel, number one, this is a prime example of why I don't like to hold positions through earnings, because if you get caught on the wrong side of one of these moves, it can be painful in a hurry, right? Granted, if you were bearish coming into the earnings numbers, yeah, it would have been a big profit potential. But there's really, going into earnings, there was no sign of any type of a bearish breakdown like this. The price action in the last month has been pretty strong. So what would I do as far as what would I do new here over the next week or so? I'd want to see whether price action stabilizes here. When you see a big gap like this, in all likelihood, over the next few weeks, potentially the next month or so, you'll see price action try to fill at least part of that gap. Right? I don't want to chase a new bearish position down here because it's already down 11%. You're chasing at this point. So I am not interested in doing anything on Intel until we start to get at least an attempt at a bounce. I'm not saying we have to fill the whole gap and move to the upside 10 or 11%, but I would wait. I would give it a couple of days, reevaluate next week to see if we get any type of a bounce potential. So yeah, I wouldn't be touching Intel here at the moment. I would just be staying flat. And then we can ask me again Wednesday if you're able to join us Wednesday next week, Robert, and we can reevaluate, see if there's anything new to do at that point. Right? Perfect. Well, if you have any other questions, go ahead and get those in now. Otherwise, again, enjoy your weekend, everybody. And I will be back on Wednesday next week, and we'll pick it up then.